This podcast contains content generated or significantly edited using artificial intelligence tools. All information is provided for general informational purposes only and reflects knowledge available at the time of publication. It does not constitute financial, investment, or legal advice. We recommend that listeners verify the information independently and consult with qualified professionals for personalized advice. Welcome to the Luxembourg Fundcast. Today we're diving deep, really deep, into the legal and regulatory side of things in the Luxembourg Financial Center. Our mission, if you like, with this deep dive is to take all this source material, the articles, research, official guidance, and really pull out the core insights, give you a practical handle on this, well, very dynamic environment, especially if you're involved in funds or capital markets.
That's right. Yeah, think of it as your expert walkthrough of the whole architecture. We'll start with why Luxembourg is so attractive, fundamentals. Then we'll zero in on the regulations, particularly the CSSF, the Mission de Surveillance du Secteur Financier. They're pivotal. Then we'll look at how you actually get into the market, authorizations, approvals, that sort of thing. And a really crucial piece we need to unpack is the role of legal opinions. It's evolving, becoming more central.
Legal opinions, right.
And then we'll spotlight some key legal tools, like the Securitisation law, the financial collateral law. And we can't ignore the big shifts, MiCAR, digitalization, they're reshaping things right now.
So why drill down into this level of detail? Why does it matter specifically to, you, our listener?
Well, look, if your work touches Luxembourg finance, maybe you're a legal counsel on cross-border deals, or a compliance officer making sure everything lines up with the latest circulars.
Or a fund manager structuring a vehicle.
Exactly. Or even a strategic decision maker thinking about where to base operations. Understanding these specific bits isn't just, box ticking. It's fundamental. It's about managing risk properly, staying compliant in a complex world, and honestly, using Luxembourg's unique strengths to your advantage. This isn't just theory. It's about practical application, navigating the complexities day to day.
Okay, let's unpack this then. Let's start right at the beginning. Why Luxembourg? What gives it this enduring appeal as a major international financial hub? I mean, the sources make it clear it's not just any financial center, it's a premier one, especially for funds, private equity, capital markets. So what's really driving that sustained success?
Well, the sources consistently point to a few really solid pillars. First, and maybe most importantly in today's world, is stability. Political stability, economic stability. That's the bedrock, right?
Right.
Gives confidence for long-term investments, complex structure.
Absolutely crucial.
Then there's the workforce. It's not just skilled, it's genuinely multilingual. Think about cross-border finance deals, spanning different languages, legal systems daily. Having people who can navigate that smoothly, that's a huge practical plus.
Makes sense.
But, arguably the real cornerstone, the thing highlighted again and again, is the legal and regulatory environment. It's sophisticated, it's adaptable, and it's frankly very well regarded internationally.
And these aren't separate things, are they? They work together.
Exactly. It's like building something complex, say a high-performance bridge. You need solid ground, that's the stability. You need expert engineers and builders, that's the skilled workforce. And you need a precise, adaptable blueprint, that's the legal and regulatory framework. Luxembourg offers that rare mix. It makes it fertile ground for really sophisticated operations, those complex cross-border deals that need absolute precision and legal certainty.
And for our listener, the professional working in this environment, how does that stable, skilled, legally sound setup directly impact your day-to-day?
It translates into real benefits. Reduced risk is probably the big one. Stability minimizes those big sovereign or macro shocks that can derail things. Access to talent means less friction, fewer errors. And the sophisticated legal framework, and once you understand it, it's a reliable platform. The infrastructure is there for complex stuff like cross-border fund distribution or intricate securitizations. It streamlines things that might be messy or legally risky elsewhere.
Okay, so that's the why. Now, moving to how we understand it. The source material talks about this deep dive not just being info, but expert insight, an analytical tool. Why the emphasis on expert insight?
It really underscores a key point. The Luxembourg market is sophisticated. You need more than just surface facts. You need guidance, analysis, interpretation to navigate it properly. It's just too complex for a superficial approach.
And the source material is pretty explicit about who this is for, right? Legal counsel, compliance officers, fund managers, advisors, decision makers. If that's you listening, this is tailored for your kind of challenges.
Precisely. And this need for deep guidance, it's amplified because the landscape is constantly shifting. The sources point this out clearly: digitalization, the rise of ESG criteria, ongoing EU harmonization. These forces are powerful.
And Luxembourg isn't just watching this happen.
No, it's often at the forefront, adapting, sometimes leading. These changes are fundamentally reshaping the regulatory framework. They create challenges, sure, but also new opportunities. Understanding this constant motion is critical. It means rules, requirements, expectations are always being refined. It connects back to the when staying current isn't a nice to have, it's essential for operating successfully.
Okay, so we have this stable foundation, a complex market needing expert insight and constant evolution. That naturally brings us to the authority overseeing it, all the regulatory architecture, and specifically the CSSF. So the CSSF commissioned the Surveillance du Secteur Financier. The sources call its role pivotal. What's its core job? Its scope.
According to the source material, it's the main prudential supervisor for the whole financial sector. Its reach is broad banks, investment firms, bits of the insurance sector, and crucially for many listeners, that huge ecosystem of collective investment schemes, UCITS, AIFs, ETFs, you name it.
And transparency. How do we know who's who?
Yes. A key practical point noted in CSSF communications and financial info sources is their public registers. You can go online, check the regulatory status of an entity. It's that first essential check for legitimacy.
Sounds like they're quite hands-on, not just watching from afar. The source material talks about proactive supervision. What does that look like?
Yeah, they're highly engaged. CSSF guidance mentions their active role in international groups, like AML-CFT colleges, anti-money laundering, counter-financing of terrorism. These forums are vital for sharing info, coordinating supervision across borders, essential for market integrity in a global system.
And interactions with bodies like the IMF.
It's exactly. Documents from institutions like the IMF show the CSSF provides detailed input during country consultations. They give critical data, insights into the financial sector. They're actively helping assess Luxembourg's financial health. This international engagement isn't just for show. It shows commitment to robust standards, aligning internationally, contributing to stability. And this is where it gets really interesting how the CSSF itself is adapting. They're embracing tech. Recent reports give some fascinating glimpses.
Like what?
Okay. Take DORA, the Digital Operational Resilience Act. Huge EU initiative, right?
Sure.
Boosting cybersecurity, operational resilience. The CSSF is key to implementing it in Luxembourg.
How so?
Well, firms have to notify the CSSF about major ICT incidents, for instance. Gives the regulator visibility on risks. And there are concrete deadlines. Reporting mentions firms needing to provide info on critical ICT third-party providers by April 30th, 2025. So DORA's goal is basically a more secure digital finance system.
Okay, Dora. What else?
Then there's the shift to T+1 settlement for securities. Faster settlement, less risk, happening globally, especially driven by the U.S. CSSF statements show they recognize the big operational impact processes, systems, resources. They're pushing firms to analyze this, prepare technically.
And the practical effect for firms.
It means big changes in back office work, IT system adjustments, needing different resources for that compressed timeline. It's a significant operational shift.
You mentioned the CSSF using tech itself.
Yes. This is quite forward-looking.
Yeah.
Recent reporting talks about an internal CSSF project using artificial intelligence, apparently codenamed Clarence.
Clarence. Interesting. What's the goal?
The sources say it's about boosting CSSF performance, transparency, efficiency, improving how they interact with the public and the firms they supervise. They're reportedly using Google Tech, with a big emphasis on data security. It shows the regulator isn't just reacting to market tech, they're adopting it internally to be more effective.
So, bringing it back to the listener, the professional navigating this DORA, T+1 prep, the regulator using AI, how does this practically hit your desk, your strategy?
Well, the analysis alongside the sources points to major consequences. You will need better tech capabilities in your firm. Cybersecurity needs beefing up for DORA. IT systems need adapting for T+1.
Which means more compliance work.
Definitely. Bolstering compliance frameworks, new reporting streams, keeping up with evolving technical standards. And yes, that often means higher operational spending, investing in systems, training staff, maybe hiring specialists.
But there's an upside.
The analysis frames it as foundational steps. Yes, it costs, but it's towards a more resilient, transparent, ultimately more innovative market. It's future-proofing. It really hammers home the need for continuous learning. You can't just set up systems and forget them. They have to evolve constantly.
Okay. And what about supervising the really big players?
Right. Reporting also mentions their role with OSIIs, other systemically important institutions. These are firms whose failure could risk the whole system's stability.
Like who?
CSSF newsletters give examples. Banque et Caisse d'Épargne de l'État, BIL, BGL, BNP Paribas, Clearstream Banking, Société Générale Luxembourg. Supervising them specifically is crucial for financial stability, preventing systemic risk. And the CSSF sets specific capital buffer rates for these OSIIs, an extra layer of resilience.
So a broad scope, adaptive, tech-savvy regulator, which leads us to the practical bit. How do you actually get in? How do you get authorized to operate in this framework?
Exactly. Market access isn't one single door. It really depends on what you're doing. The source material outlines key routes, starting with, say, securitization vehicles.
Okay, securitization. Who needs the CSSF's okay for that?
Specific CSSF guidance tells us it's required for securitization undertakings that issue securities to the public on a continuous basis. If that's your model, you need authorization.
And the application, the dossier d'agrément, is involved.
It's comprehensive, based on CSSF guidance. Lots of documents detailing the structure, assets, parties, mechanics, and crucially, this shows their depth of oversight. The vehicle's constitutional documents themselves, like the statutes or management regs, need CSSF approval. Even the legal DNA needs a sign-off.
What if a vehicle wasn't regulated before but wants to start issuing publicly now?
The guidance covers that too. Existing unregulated vehicles need to get that prior approval before becoming regulated and issuing publicly on an ongoing basis. There's a defined path for that transition.
Right. Now, shifting gears completely, this newer pathway involving crypto assets, issuers of asset reference tokens, RTs under MiCAR, feels like a whole new ballgame.
It absolutely is. And the CSSF guidance is very clear here. With MiCAR, the EU's big markets and crypto assets regulation now in effect, any entity wanting to issue RTs from Luxembourg need CSSF authorization. This kicked in June 30th, 2024. A clear regulatory line drawn.
And there's a specific, quite interesting requirement for these RT issuers, isn't there?
Yes. A standout one detailed in the CSSF guidance. They must submit a projet d'avis juridique, a draft legal opinion.
A draft legal opinion, what must it confirm?
It has to formally state that the specific art doesn't fall under MiCAR's exclusions Article 2.4, and that it doesn't qualify as an e-money token, or EMT, which is a separate category with different rules.
And why demand a legal opinion right at the start of the application?
It seems like a clear strategy by the CSSF. They're leveraging the specialized expertise of private lawyers to do that initial, complex classification work for these novel instruments under the new MiCAR rules. They're essentially asking lawyers for the foundational legal analysis up front.
Makes sense. Okay, beyond specific entities or assets, what about the classic route prospectus approval for public securities offerings?
That's governed by the law of 16 July 2019, implementing the EU prospectus regulation. Generally, you need a prospectus when you offer securities to the public or seek admission to trading on a regulated market in Luxembourg.
But not always. There are exemptions.
Yes, the law has thresholds, like offers under EUR 8 million over 12 months across the EU don't need a full prospectus. But even if you use an exemption like that, the law says you still need to notify the CSSF, so they're kept in the loop.
And the CSSF's role when a prospectus is needed, they scrutinize it.
They do. The law gives them power. They can demand extra info if they think it's needed for investor protection, and they can suspend or even block an offer if they find the prospectus misleading, inaccurate, or inconsistent. It's a crucial gatekeeper role.
And there are fees involved.
Yes. Official regulations confirm the CSSF charges fees for examining and approving prospectuses. Reflects the work involved. Now, if we step back and look at these different paths, securitization approvals, the R&T legal opinion requirement, prospectus scrutiny, the analysis in the source material points to an emerging pattern.
Which is?
It's this strengthening reliance by the regulator on formal legal pre-validation, especially for complex or new activities. It seems to be elevating legal opinions. They're moving from just being a transactional safeguard for the parties involved.
Something you get for your own comfort.
Exactly. To becoming, in some cases, almost a quasi-regulatory prerequisite, something you need just to get through the regulatory gate.
So, based on that analysis, it feels plausible the CSSF might lean more on legal opinions for new products or structures in the future. Why would they do that?
Well, it's pragmatic. It taps into this specialized legal expertise already out there in law firms. The regulator faces huge demands, keeping up with innovation, right? This lets them shift some of the initial highly technical legal assessment burden onto qualified lawyers.
Especially for fast-moving areas like crypto.
Precisely. It helps them get an early read, some validation, before committing their own extensive resources. It makes sense for complex, novel areas where even the legal classification isn't straightforward.
And for you, the professional listener, what's the takeaway from this trend?
It strongly suggests increased demand for specialized legal opinions, particularly in cutting-edge fields. And it really highlights the need for lawyers to grasp not just the law, but also the underlying tech, the structures, the business models. It's this demanding intersection of law, finance, and innovation.
This deep engagement with the CSSF, navigating authorizations, the growing role of legal input, it leads us to another key way the CSSF communicates. It's circulars, right? CSSF circulars. They're not just updates. They're essential operational guides, aren't they? The source material stresses how crucial they are for compliance and understanding expectations.
They are absolutely foundational.
Yeah.
The source material, drawing from official CSSF docs and analysis, gives some key examples, like Circular CSSF 24856, very recent, very significant. It replaced the old 0277 from January 1st, 2025.
What does 24856 cover?
It's all about investor protection in funds UCIs, specifically dealing with things like NAV errors, investment rule breaches, other operational mistakes. CSSF communications say it sets minimum standards for fund actors, procedures for identifying and correcting errors, rules for compensating investors, including specific NAV error tolerance levels.
Why is that so critical?
Because it directly impacts fund integrity. It's
Yeah.
about protecting investors and maintaining confidence in the Luxembourg fund sector. It's core stuff.
Okay. What other key circulars are highlighted?
Another cornerstone, though older and amended, is Circular CSSF 12552. This one targets credit institutions, lending firms. It lays out requirements for governance, risk management, internal controls.
So things like organizational structure.
Exactly. Structure, clear responsibilities, robust risk frameworks covering credit risk, concentration risk. Supplemental EBA guidelines, which the CSSF often integrates, stress managing concentration risk exposure to single counterparties or sectors. Why is 12552 foundational? It sets the bar for operational soundness, prudent management, essential for stability.
Any newer examples?
Well, there's Circular CSSF 25885. This one's linked directly to MiCAR implementation. It essentially translates the EBA's guidelines for supervising RT issuers into Luxembourg practice.
Why is that helpful for firms?
It provides national-level clarity, takes the EU guidelines and shows how the CSSF will apply them specifically, helps entities know exactly what's expected in this new MiCAR world.
Yeah.
And a general point from various CSS FAQs and guides is interesting too. They explicitly invite professionals to consult a lawyer or a specialist jurist if they're ever in doubt about applying a rule.
The regulator actually says that.
Yes, explicitly. Why is that significant? It's a clear nod to the complexity of the rules. It reinforces how important, how necessary expert legal advice really is. They're basically saying, this stuff is complex, get help.
Resume. So if you summarize the CSSF's overall approach as the analysis does, you see a regulator that's highly engaged, comprehensive, and really quite adaptive.
Adaptive how?
Through these detailed circulars and FAQs, tackling practical issues, through adopting new tech, like that Clarence AI project, through proactive guidance on big shifts like T+1 and DORAR, they're clearly trying to stay ahead and provide clarity.
And the key takeaway for the listener from all this CSSF activity?
It's undeniable. This dynamism demands commitment from you. Continuous learning, continuous adaptation. You have to stay on top of CSSF communications, understand new rules instantly, be ready to adjust your internal systems, procedures, compliance frameworks. It's not a one-off task, it's an ongoing way of operating.
And the CSSF's advice to get legal counsel reinforces that.
Absolutely. It's not just for tricky one-offs. It's a recognition that even experienced pros need support navigating this constantly evolving landscape.
This constant need to interpret complex, changing rules, especially for sophisticated deals and new instruments. It brings us squarely to a critical tool in Luxembourg, the legal opinion. Legal opinions. The source material presents them as more than just advice. They're a critical instrument in Luxembourg deals. What exactly are they, and why so critical?
Right. According to the analysis, a legal opinion is a definitive confirmation of specific legal points within a deal. It's a formal document where a law firm attests that certain legal goals are met, or specific legal facts exist, on a certain date. The key word is confirmatory. It's a reasoned judgment on specific questions under a defined scope of law, usually Luxembourg law.
And their function.
Commentary describes them as a cornerstone, especially for complex, high-value cross-border deals. They're seen as a sophisticated tool for risk management, helping deals conclude successfully. They clarify legal points, mitigate risks up front. But it's crucial to remember their limits, as the analysis notes. They're not an insurance policy. They have a defined scope, assumptions, qualifications.
And getting one or understanding one requires real expertise.
Absolutely. Commentary stresses this. Both issuing and interpreting them needs seasoned professionals with deep specific knowledge of Luxembourg law relevant to that deal type.
Why is that expertise so essential?
Because the opinion's value hinges on asking the right legal questions, doing a rigorous analysis, and accurately framing the conclusions, especially understanding the assumptions it makes and the qualifications limiting its scope. Without that expertise, you could misunderstand the actual comfort it provides. Commentary also mentions downsides. Getting an opinion can mean more scrutiny, costs, maybe time added to the deal. And for the lawyers, errors have serious liability implications.
So why is the investment often justified?
Because in high-stakes finance, like many Luxembourg deals, that legal certainty provided by a well-drafted opinion, despite the cost and time, is often paramount for managing risk. Lenders or investors frequently require it.
So if you're involved in a deal with a Luxembourg legal opinion, jetting one or relying on one understanding these nuances, the purpose, limits, expertise, costs is key to managing expectations and getting real value.
Okay, so when are they typically indispensable? When do you absolutely need one? The source material and commentary point to several common triggers. Financing deals are probably the most common. Any significant financing involving Lux entities or assets. Lenders will almost certainly require opinions on the validity and enforceability of the finance and security docs under Lux law.
Why do lenders always ask for this?
It's fundamental assurance for them. Assurance on the legal soundness of their loan, their ability to enforce rights against the Lux borrower or collateral in Luxembourg. Basic stuff for a lender. Securitization transactions too, right? A cornerstone of Lux finance. Yes, opinions are particularly crucial there. Commentary notes they confirm specifics vital to the structure's integrity under the securitization law. Things like, is the vehicle unregulated, if applicable? Does it comply with asset management rules in the law? Is compartment segregation legally effective? What's its AIF, MDIM, all law status? And vitally, is its center of main interests, COMI, genuinely in Luxembourg for bankruptcy remoteness?
And complex or cross-border deals generally.
Commentary explicitly calls opinions a cornerstone for those. More complexity, higher stakes, multiple jurisdictions involved. Formal confirmation on the Lux law aspects becomes invaluable for risk mitigation. And remember, many Lux securitizations involve foreign assets, making the Lux law opinion on the SPE's integrity and COMI absolutely critical in that cross-border mix.
We touched on this, but regulatory authorizations are now a trigger too.
Increasingly so, it seems. That CSSF requirement for the projet d'avis juridique for art issuers under MiCAR is the prime example. It embeds the opinion within the regulatory approval process itself. It reinforces that idea of the regulator leveraging private legal expertise. And yes, as we speculated, could this foreshadow a broader trend in other complex areas? Possibly. Shifting some initial assessment burden, and finally just general prudence. Remember the CSSF's advice. Consult lawyers if in doubt. Even if it doesn't end in a formal opinion for third parties, the need for expert legal input in uncertain situations is a constant.
So for the listener, if you see these flags, big financing, securitization, complex cross-border deal, MiCAR application, or just a really tricky regulatory point that should immediately trigger the thought, we need a Lux legal opinion here.
Okay, let's look inside one. What's the typical anatomy of a Luxembourg legal opinion, based on the source material and standard practice commentary? What are the key parts? Well, they usually start with standard confirmations. These cover basic corporate stuff about the Lux entities involved. Are they properly incorporated? Do they exist legally? Do they have the power and authority for this deal? Have the right board or shareholder approvals happened?
So checking the basics are in order.
Exactly. Then confirmations about the transaction documents themselves. Were they properly executed? Are they legally binding, enforceable obligations under Lux law, subject, of course, to qualifications? Commentary says this covers core warranties on party status, validity, enforceability.
And for specific deal types like securitization, you get tailored confirmations.
Absolutely. For securitizations, as the analysis shows, you'll see confirmations specific to the securitization law. Is the vehicle unregulated? Does it meet asset management rules? Is compartment segregation solid? What about AIFM, AIMFM status? And that crucial CUMI confirmation is in Luxembourg. all essential for the structure's integrity and bankruptcy remoteness.
What about deals involving foreign law? How do Lux opinions handle that?
Typically, a Lutz opinion won't opine on foreign law matters, but commentary notes they'll acknowledge the choice of law clauses in the docs. They might refer to relevant conflict of law rules, like Article 14 of Rome for assignment of receivables enforceability. It highlights that that aspect is governed by the receivables' own law, not necessarily Lux law. It shows the careful scoping needed in international deals.
And then there are always assumptions and qualifications. Why are they always there?
Because no opinion is an absolute guarantee. Assumptions are things the lawyer takes as given without checking independently, like signatures are genuine, documents provided are complete, foreign law contracts are valid under that law.
Okay. And qualifications?
Qualifications limit the opinion scope or point out specific situations where the conclusions might not fully hold. Common ones relate to insolvency laws overriding contracts, principles of equity or good faith affecting remedies, limits on getting specific performance from courts, requirements for reasonableness, and usually excluding tax or future law changes unless specifically covered.
So understanding those assumptions and qualifications is just as important as the main confirmations.
Absolutely critical. They define the boundaries of the legal comfort. They're not just fine print. They're integral to what the opinion actually means. And the analysis emphasizes, with increasing complexity, digital assets, intricate cross-border stuff, issuing and reading opinions needs even more specialized expertise. Lawyers need mastery of Lux law, international rules like Rome 1, and the tech implications. It's a demanding field.
How are these opinions keeping up with innovation, the digital age?
MiCAR is the perfect example. That required legal opinion for RT issuers. It shows opinions are now essential tools even in this new world of regulated digital finance. Commentary points out legal practice has to keep pace. Lawyers need expertise in both traditional law and the tech.
Is the process of getting an opinion on new things valuable in itself?
Analysis suggests yes. The dialogue involved in getting an opinion on, say, smart contracts or digital transactions helps shape practical, legally sound ways to integrate these innovations. It's part of the solution-finding process.
So for the listener, as finance gets more digital, your need for legal opinions covering these new areas, crypto, tokenization, smart contracts, is only likely to grow. It'll be crucial for navigating the legal side confidently.
Okay, moving from the broad regulatory picture and the tool of legal opinions, let's put a spotlight on some specific foundational legal frameworks. These underpin key instruments and structures that really make Luxembourg a leader in certain fields. Right? Luxembourg is definitely a top jurisdiction for securitization, and that's largely down to its specific, flexible legal framework, the securitization law. The core law is from 22 March 2004. What makes it so versatile, so globally attractive? CSSF guidance and legal commentary say it allows securitizing an incredibly wide range of assets, risks, activities.
So almost anything generating cash flow or representing a risk?
Pretty much. Traditional mortgages, trade receivables, sure. But also more esoteric assets, even operational risks. That flexibility is a major draw.
And the really critical feature, the cornerstone, is its focus on bankruptcy remoteness.
Absolutely key. The 2004 law, as commentary points out, specifically enshrines principles vital for strong bankruptcy remoteness. Two big ones, limited recourse and non-petition clauses.
Can you break those down? Limited recourse.
Article 62 of 1 of the law statutorily limits investor and creditor rights. They can only claim against the assets of that specific undertaking or compartment, if those assets aren't enough. Generally, no recourse against other assets of the SPE, if multi-compartment, or the originator. It ring-fences the risk.
And non-petition clauses?
Article 64.1 explicitly validates clauses where parties agree not to start bankruptcy or insolvency proceedings against the securitization vehicle.
And why is it so powerful that these are statutory provisions in the law itself?
Because it gives them immense weight. It significantly bolsters the structure's robustness against the originator's insolvency. It provides a high degree of legal certainty that the SPE and its assets will stay separate and protected from the originator's creditors if the originator fails. Commentary also notes things like documentation and governing law. Transaction docs can be under foreign law. The law governing the asset transfer itself is often foreign, given the cross-border nature. But the Lux opinion covers the Lux SPE's validity and the effectiveness of these bankruptcy remoteness features under Lux law.
Does the law cover both regulated and unregulated vehicle?
Yes. CSSF authorization is needed for continuous public issuance, as we discussed. But commentary suggests many Lux securitizations use unregulated vehicles. And importantly, these still benefit from the core principles of the law, especially bankruptcy remoteness, limited recourse, compartment segregation.
And understanding a securitization means knowing the players. The sources list quite a few. Can we quickly recap who is involved?
Sure. You have the originator seller. They hold the assets initially, sell them to the SPE. The SPE itself, the Luxembourg vehicle, bankruptcy remote, buys assets, issues securities. The servicer manages the assets day-to-day, collects payments, often the originator, but can be a third party, maybe a trustee for investors. Investment banks structure the deal, underwrite securities. Legal, tax, accounting advisors, essential expertise. Rating agencies assess credit quality, vital for investors. Auditors required for corporate SPEs. And calculation reporting agents handle the payment waterfall. Investor reports. It's a whole ecosystem.
And the analysis adds a point about how these laws work together.
Yes, a crucial one. The securitization law and the financial collateral law are synergistic. The statutory bankruptcy remoteness from the securitization law, plus the clear, strong rules for creating and enforcing security from the financial collateral law. That combination creates a highly legally secure environment for structured finance here. Segregation plus efficient collateral equals reduced risk, more efficiency.
Okay, that takes us neatly to that other cornerstone, the financial collateral law of 2005. What was its main goal?
It's definitely another pillar, yeah, especially for capital markets, secured deals. Source material says it implemented an EU directive, 2002/47/EC. The big idea was to create a clear, harmonized, efficient framework for financial collateral across the EU, reduce legal uncertainty, especially cross-border, make collateralization reliable, help markets function smoothly.
What kind of assets and arrangements does it cover?
The scope for assets AFWA is broad. Financial instruments, securities, cash claims like account balances. And the arrangements are flexible too. Pledges, title transfer for security, repos, security trusts, fiducie sûreté.
Let's talk about constitution, making the security effective, perfecting it. How does this law make that robust?
It provides clear, fairly simple rules. The arrangement needs to be evidenced in writing, importantly. Electronic or other durable medium is fine. Assets need identifying. For book entry securities or cash in an account, just crediting them to an account held by or for the collateral taker is enough. That's it.
What about receivables, like assigning claims?
Big simplification there too. Just putting the receivables on a list sent to the collateral taker is enough for the pledge or assignment to be effective against the debtor and third parties.
Why are these streamlined methods such a strength?
They avoid complex formalities. They provide certainty. They're modern, suited to the speed and volume of financial markets. Simple, certain, efficient perfection. And then there's opposability and enforceability against third parties, especially in insolvency. The law is designed for this. It limits insolvency's impact on these collateral deals.
And that point about waiving set-off rights?
Yes, Article 1.5 is powerful. It lets the debtor of a pledged receivable waive set off rights or other defenses they might have against the original creditor, the pledger. And crucially, the law says this waiver is not just valid between the parties, but opposable TA, enforceable against third parties too.
How does that boost certainty?
It protects the collateral taker. The value of their pledged receivable isn't suddenly reduced by unexpected counterclaims the debtor might have against the original creditor. This makes the collateral value much more predictable. The law is also flexible about parties. Collateral can go to agents or trustees for beneficiaries, like bondholders, and the collateral provider can waive recourse against the underlying debtor of the secured obligation again, valid and enforceable against third parties.
So putting it together again, securitization law, financial collateral law, they work hand in hand. Clear, certain, modern frameworks making Luxembourg very attractive for structured finance and secured deals. That clarity and certainty are huge draws.
Absolutely. And the analysis highlights this consistent legislative approach, statutory limited recourse, robust collateral rules, clear frameworks for new areas like MiCAR. It points to a deliberate commitment to high legal predictability. That predictability is a core value proposition, reducing legal and operational risks.
Speaking of new areas, MiCAR. Big EU regulation for crypto assets. Why now?
MiCAR markets in crypto assets regulation. It's the EU's response to crypto's rapid growth. The regulation's own explanation says it's part of the digital finance package, filling the gap for crypto assets not covered by existing EU financial laws.
What are its main aims?
Several, according to the regulation and commentary like those Stanford law papers. Legal certainty for crypto activities in the EU, supporting innovation while managing risks, protecting consumers and investors, and ensuring financial stability, especially regarding stablecoins, which MiCAR mostly calls ARTs, asset reference tokens, and EMTs, e-money tokens.
And how does it apply in Luxembourg?
directly as its EU regulation. And as we saw, entities issuing RTs from Luxembourg needs CSSF authorization per CSSF guidance. They've set up contact points and published info to help firms navigate this.
And that legal opinion requirement for RTs keeps cropping up.
Yes, the CSSF guidance makes it clear. Submit a projet d'avis juridique, a draft legal opinion, confirming the token's classification. It is an art, not excluded, not an EMT. Again, it shows the regulator relying on legal experts for classifying these novel things under a new framework. The supervision set up under MiCAR, as commentary describes it, usually involves national authorities like the CSSF supervising RTMP issuers. But if an ART or EMT or its issuer gets deemed significant, based on criteria like large customer base, high market cap, high transaction volume, as set out in EU texts, if deemed significant, supervision moves up to the European Banking Authority, EBA.
So summing up MiCAR in Luxembourg, their proactive approach, early authorization process, legal opinion requirement positions them as ready for regulated crypto activity within the EU.
That's the clear signal from the CSSF's guidance. Why does that matter to you, the listener? It positions Luxembourg as a clear, regulated hub for crypto businesses in the EU. That regulatory clarity is very attractive to firms wanting legitimacy. It could draw significant investment and activity, creating opportunities here. Okay, let's now bridge these specific laws to broader concepts of validity and enforceability, especially when things get tough, like in financial distress.
Let's talk opposability again, core legal concept. What is it, and why is its strength so vital for security in complex deals?
Right, opposability. It's about how binding a contract or right is, not just between the original parties, but crucially, against third parties, people, or entities not part of the original deal whose interests might be affected. Why critical? In complex finance, you have layers of parties, assets potentially subject to competing claims, like from creditors in an insolvency. Knowing your rights or security are legally effective against those third parties is paramount for security and predictability.
And we've seen this principle embedded in the laws we just discussed.
Powerfully so. The financial collateral law is designed for high opposability, that waiver of set-off by the debtor being explicitly opposable au tiers under the law. Perfect example of boosting certainty against third-party claims that could hit collateral value. And in securitization, the bankruptcy remoteness features limited recourse. Validated non-petition clauses are fundamental to the opposability of the SPE structure and asset segregation. The law makes these effective, ensuring the assets are protected, opposable, against the originator's creditors if the originator fails. Maintains the securitization's integrity.
What about cross-border situations, like assigning receivables?
Commentary points to Article 14 of Rometa. That EU rule says enforceability against the debtor and third parties is governed by the receivables law, not necessarily the assignment agreements law or the SPE's law. Legal opinions need to factor this in. Shows how EU conflict of law rules meet national law to determine opposability internationally. General contract law provides a base, of course, but in finance, these specific reinforced opposability principles from specialized laws are key. The analysis concludes Luxembourg's transactional robustness comes from this interwoven fabric. Specialized national laws, securitization, financial collateral, EU regulations, Rometa, specific resolution regimes. Opposability is the crucial outcome, reinforced by structuring, validated opinions.
But what if a party does hit financial distress? How do these frameworks hold up under insolvency or resolution?
Good question. Luxembourg has general insolvency laws, souci de paiement, reorganization, suspension, faillite, liquidation, bankruptcy. Some historical commentary noted potential uncertainties in older regimes needing case law clarification, highlighting the ongoing need for legal predictability.
And for banks and key investment firms, there's that separate recovery and resolution regime. Why the special treatment?
Because of their systemic importance. A big bank failure could destabilize everything. So the Law of 18, December 2015, implementing the EU's BRRD, Bank Recovery and Resolution Directive, provides a framework for orderly resolution, avoiding chaotic insolvency. It gives powers to resolution authorities, the Resolution Board, with CSSF representation.
What kind of powers?
The BRRD framework distinguishes resolution from normal insolvency. It defines contrats financiers, which gets some protection. But the key implication, analysis highlights, is that while Lux law generally supports contracts, the bank resolution regime introduces overriding public interest powers. In specific crisis conditions, resolution authorities can use powers like bail-in, transferring assets, modifying contracts, potentially affecting even contracts' financiers to ensure critical functions continue, maintain stability, minimize taxpayer costs.
So even strong contractual rights aren't absolute in that specific context.
It's exactly. Legal opinions on entities subject to BRRD need to acknowledge these potential overriding powers. Public stability can, in specific circumstances, trump private contracts under this regime. However, it's important to stress again, the financial collateral law is designed to shield covered deals from certain insolvency effects, like stays. And the securitization law's bankruptcy remoteness features are specifically designed to protect the SPE from the originator's insolvency.
So for the listener, understanding how these regimes interact, general insolvency, specific protections like financial collateral and securitization, and the BRRD overlay for banks, especially in distress, is vital for assessing risk and structuring resilient deals. Knowing which rules apply where is key.
And beyond the laws themselves, the whole system relies on the ecosystem of professionals working within it. The source material brings this human element into focus. We listed the many parties in securitization earlier: originator, SPE, servicer, trustee, banks, advisors, raters, auditors, agents. Each role is critical. The deal's success depends on their specialized expertise and clear execution of responsibilities. It's an interconnected network.
Are there other examples of these ecosystems?
The source material mentions third-party litigation funding, TPLF, as gaining traction. Different setup, but still an ecosystem. The funder providing capital, the plaintiff with the claim, their lawyers. Commentary notes a potential Lux bill on class actions, which could boost TPLF, possibly bringing supervision for funders to prevent undue influence. Shows evolution here too. And finally, back to legal opinions. The parties to the opinion are part of this ecosystem too. The issuing law firm lawyer providing the judgment, and the addressee's relying parties, lenders, investors who need that assurance.
And the overall point about this ecosystem?
The analysis strongly emphasizes that the effective functioning, the integrity of the whole sophisticated Luxembourg financial system profoundly relies on the specialized expertise, professionalism, and clear roles of all these diverse actors. The human element, the competence, the ethics of the lawyers, accountants, bankers is critical for compliance, risk mitigation, and the center's reputation.
Okay, a comprehensive journey. We've covered the appeal, the regulator, market access, legal opinions, key laws, enforceability, distress scenarios, and the professionals involved. Let's try to synthesize this into some key strategic insights.
Right, recapping the strengths highlighted throughout. Luxembourg shines because of its sophisticated and responsive regulator, the CSSF. Its robust, specialized laws like securitization and financial collateral, that deep pool of skilled practitioners, and its proactive stance on innovation, like with MiCAR.
And the central thread running through everything, the main conclusion from the analysis.
It's the absolute necessity of thorough due diligence and relying on specialized Luxembourg legal advice. You just can't succeed here without it. Navigating complex rules, structuring sophisticated instruments, getting approvals, assessing enforceability, it all demands expertise.
Even the CSSF says so.
Exactly. Their own advice to consult lawyers proves the point. It frames expert legal counsel not just as a cost, but as a fundamental strategic imperative for managing risk, for efficiency, for deal success.
So the core takeaway for you, the listener, your own expertise combined with careful navigation and timely, specialized legal support are the absolute keys to unlocking Luxembourg's potential for your business or clients.
And looking ahead, what should market participants expect? The source material suggests continued evolution, ongoing adaptation to more EU legislation, and maybe more in digital finance, sustainability, a persistent regulatory focus on investor protection, market integrity, financial stability, and that continued embrace of digitalization, DORA, data protection, digital assets.
It sounds like a balancing act.
The analysis calls it a dynamic equilibrium, balancing innovation, like MiCAR, with robust oversight, CSSF, and strong legal certainty, financial collateral law. And maintaining that balance isn't static. It needs constant adjustment, vigilance from both the regulator and the industry.
Which leads to the final directive from the source material.
Yes, essentially. Yeah. The opportunities in Luxembourg are substantial, no doubt. But you must approach them with foresight, grounding strategies in a deep understanding of the legal and regulatory details. That means continuous monitoring, proactive compliance, engaging expert advisors.
And by doing that?
By committing to that diligence and expertise, you can confidently and effectively leverage the unique and powerful strengths of the Luxembourg Financial Center.
hit that like and subscribe button. It was the Luxembourg Fundcast podcast for you today. This podcast contains content generated or significantly edited using artificial intelligence tools. All information is provided for general informational purposes only and reflects knowledge available at the time of publication. It does not constitute financial, investment, or legal advice. We recommend that listeners verify the information independently and consult with qualified professionals for personalized advice.
So here's a final thought to chew on. Given the CSSF's clear reliance on legal opinions for classifying new things like IARTs under MiCAR and the sheer complexity of digital finance, how might the actual role, the boundaries, and perhaps even the liability landscape for legal opinions and the lawyers issuing them continue to shift and maybe even expand in the years ahead? Something to consider.